Welcome to The Explainer. If you're the kind of person who loves dissecting complex systems, well, you are absolutely in the right place. Today, we're unraveling the fascinating and super high-stakes world of quantitative trading. We're going to look directly at the data to understand exactly how mathematical models are built to conquer the financial markets, and, perhaps more importantly, why they so often just completely collapse the moment they're actually deployed.
You know, it all really starts with this massive, multi-billion-dollar paradox. Why do trading algorithms that have absolutely perfect historical track records end up losing money in the real world? I mean, if the math is so flawless on paper, why on earth doesn't it translate to reality? Okay, let's dive into this.
Here is how we're going to break it all down today. First, the perfect backtest illusion. Second, the hidden cost reality. Third, walk-forward validation. And finally, the G-score solution.
Starting right off with Section 1, the perfect backtest illusion. All right, let's meet the primary villain of our explainer today, backtest overfitting. So in mathematical finance, backtest overfitting happens when you use historical market data to develop a strategy, but then you try millions of tiny variations of that strategy on the exact same dataset. The model ends up targeting highly specific, totally random idiosyncrasies of that limited data instead of finding actual general market behavior. In plain English, the algorithm is just memorizing the past instead of actually learning how to predict the future.
To really wrap our heads around this, there's this brilliant analogy from the research regarding medical trials. Imagine testing a new headache pill. If there's a 5% chance of a false positive, and you just keep changing totally irrelevant things, like the color of the pill, the shape, the taste, and you retest it over and over, eventually, purely by mathematical chance, one of those variations will falsely show that the pill cures headaches. As the saying goes, if you torture the data long enough, it'll confess to anything. The problem here isn't the biology, it's the multiple testing phenomenon. And in finance, researchers do this exact same thing. They run billions of variations of an algorithm on identical historical data until they falsely stumble onto a winning strategy. Mathematically, it's pretty much guaranteed to happen eventually.
And this brilliantly illustrates the trap. Take a look at the in-sample historical backtests here on the left. By tweaking parameters like the entry day, the holding period, and the stop loss, researchers basically built an optimal strategy with this beautiful, steady upward climb and an incredibly strong Sharpe ratio of 1.59. I mean, it looks like a literal money printing machine. But when you take that exact same strategy and force it to face the out-of-sample, unseen reality on the right, it instantly crashes, yielding a disastrous negative Sharpe ratio of negative 0.18. It actually lost money. The model just memorized historical data and was completely blind to the new reality.
Now, you might be wondering, are complex academic models somehow immune to this? Absolutely not. Take a look at a simulation from a tool called the Tenure Maker. What it does is look for pseudo-mathematical econometric specifications that maximize predictive power on completely random, unpredictable data. Because these econometric equations are so flexible, they're actually even easier to overfit. Literally in a matter of seconds, the program spits out this wildly profitable equity curve with an absurdly inflated Sharpe ratio of 2.45. It is a complete statistical illusion. Moving on to Section 2, the hidden cost reality. Research from the TradeQuant platform exposes these massive systematic biases in conventional backtesting. First up, we have the zero-cost simulation assumption. So many models assume frictionless trading, completely ignoring the bid-ask spread and broker commissions. On a high-frequency strategy, a tiny 20-cent per trade cost differential can take a simulated fortune and turn it into a real-world bankruptcy. Second, uniform cost assumptions. Algorithms will incorrectly apply the exact same cost rules to Bitcoin, gold, and the euro, totally ignoring their very different pricing structures. And third, gap blindness. Think about why this matters. Markets close on weekends, and prices gap when they reopen. Millions are lost simply because simulations often pretend these gaps don't exist, which wildly inflates the simulated profits.
Which brings us right to Section 3, walk-forward validation.
Okay, so how do data scientists fight back? To stop overfitting, researchers use this really rigorous structure called walk-forward validation. Instead of testing on one giant chunk of history, they break it up into pieces. Step 1 is optimizing the strategy on a rolling 12-month training window. Step 2 is absolutely crucial, a 30-day embargo period. This basically creates a gap between the training data and the testing data so that no subtle patterns can leak into the future. Finally, Step 3, they validate the strategy on a clean, untouched 3-month out-of-sample window. If the algorithm can actually survive this unseen data, well, it might actually have a real edge.
And that leads us to Section 4, the GT score solution.
Now, what's really interesting here is the stark contrast between the old and new approaches. Traditional metrics tell an algorithm to basically just maximize simple profit or the Sharpe ratio. But as we know, algorithms can easily corrupt this by overfitting. Enter the GT score, or golden ticket score. It's a composite objective function that forces the optimizer to pass a multi-layered test. It throws in a z-score to demand true statistical significance, an r-squared value to demand consistency, so the algorithm can't just rely on one incredibly lucky trade, and downside deviation to strictly penalize risk. It literally stops overfitting directly at the source.
But the real question is, does it actually work in practice? The true test of any model is its generalization ratio, which is just a fancy way of saying how much of a strategy's simulated performance actually survives out there in the real world on out-of-sample data. Baseline methods, like optimizing for the Sharpe ratio or simple profit, only retain an average of 18.5% of their simulated performance. The GT score, on the other hand, retains 36.5%. It is specifically designed to sacrifice just a tiny bit of unrealistic simulated profit in exchange for a massive boost in real-world reliability. I really want to pause and emphasize just how significant that leap is. By utilizing the GT score over baseline objective functions, researchers achieved a stunning 98% improvement in the generalization ratio during walk-forward validation. Strategies optimized this way retain nearly twice as much of their training performance when applied to unseen data. Make no mistake, this is a total game changer for quantitative research. Now, remember those pesky hidden transaction costs we talked about earlier? Notice how the out-of-sample return behaves as simulated costs increase along the bottom axis, all the way up to 10 basis points per side. That robust parallel slope you're seeing proves that the benefits of the GT score hold perfectly strong even when factoring in those severe trading frictions. It doesn't just rely on some high turnover noise that instantly vanishes the second a broker decides to charge a fee.
So, we've seen how overfitting creates perfect illusions, we've looked at how hidden costs destroy margins, and we've explored how innovations like walk-forward validation and the GT score offer some pretty incredible solutions. But I want to leave you with one final thought to ponder today. Even with the most robust testing environments and the most advanced composite metrics on the planet, can any mathematical model, which is fundamentally built on historical data, truly predict a financial future that looks absolutely nothing like the past? It's a fascinating limitation of science and human behavior to consider. Thank you so much for hanging out and learning with me today on The Explainer, and keep asking those big